Hi, my name is Ray, and welcome back to another video of Ray's Investment Clue Book. Today, we will be talking about the second part of our money market unit, money market and cash equivalents. So last time we talked about treasury bills, CDs, or certificate of deposits, we talked about repos, and this time we talk about the expansion of more topics that are within the money market instruments. And so first of all, there are euro dollars. Euro dollars are basically just simply dollars that are held outside of U.S. territory, hence the name euro dollars. Of course, these dollar deposits of outside the U.S. territory, basically offshore deposits, are not FDIC insured, and so they're really not backed by anything. And so you just have to trust the depository institution at that point. So that's one category of money market institutions. A second one is federal funds. Federal funds isn't really an instrument. It's not something that you as an individual can trade or use in your trade. But it's actually a benchmark used by many money market managers. And so federal funds basically are dictated by the Federal Reserve, artificially dictated, and it's basically the fund of borrowing between banks through federal funds held in Federal Reserves, borrowing between banks such as to fill up the bank reserves or other purposes. And so this benchmark is watched by many money market managers due to federal funds' impact on the rest of the market for loans and just money market in general. And of course, the federal funds rate, of course, it's within the United States. Of course, another important rate in another important economy and important market is the London Interbank Offer Rate, or LIBOR. And so the LIBOR market is basically just basically the same concept as the federal fund rate, except in London among banks there. But however, it's a benchmark basically for European money market funds that may also have impacts globally. But of course, more importantly, it's determined naturally per se, determined by the market demand-supply equilibrium, instead of, say, artificially determined by the Federal Reserve, such as in the United States. However, not all money market accounts are the same. Money market accounts offered by banks through, say, their checking accounts that can incorporate money market accounts. These are typically safe because they're backed up by the FDIC, or the Federal Deposit Insurance Corporation. And so they're backed up by FDIC, and so basically you have something to trust, but you can trust the federal government, basically, if you don't really trust a depository institution. And so, of course, there are also money market funds offered privately by, just other, say, mutual funds. And so, these are mutual funds, or these just funds that offer money market funds. They obviously, they're private, so they're not FDIC insured. And so, basically, when you make these investments, these are supposed to, most investors, these are supposed to basically just be money, cash. They're supposed to be cash equivalent almost. So their net asset value should at least be $1 because they should be cash equivalents. However, if they dip below $1, dip as low as 0.8 or 0.9, they break the buck, and this has even further ramifications, further waves, because of course a market panic can draw it down even further. And so that's always a risk. Say in 2008, of course, the Lehman Brothers defaulted. So imagine if you had a money market account through a mutual fund that invested in Lehman Brothers, and that mutual fund is now, it's going to suffer losses, your money is going to suffer losses, or in something that should have been a cash equivalent has now lost value. Your cash basically has lost value. And so another example would be the Penn Central default in 1970. So the risk here is basically you're putting your cash in someone else's hand and suddenly you have less cash. So that's always a risk, of course. And of course, for a final clue, just know that the money market and things that are supposed to be cash equivalent is very diverse, and it's important in all asset allocations because the money market, it's almost a way, not actually just a way to earn returns. It's a way to store your cash in a safe environment that you know you can trust. And that's basically a storage chamber, basically. It serves two roles. And so for that reason, it should be an important part of a portfolio. Thank you. See you next time.